Hello everyone, this is Ted Bauman, editor of the Bauman Letter here at Banyan Publishing. I'm here at Total Wealth Symposium with Charles Mizrahi, who is one of my favorite people to read or listen to when it comes to investing. The way he describes his approach to investing is just, to me, one of the most basic and easy to understand and the most correct. So Charles, welcome.
Thank you, Ted.
What do you look for when you're investing?
Well, I take this very simply. You know, I look at this as a business, like a businessman would want to own a business. And stock is nothing more than a piece of a business, right? What's a share? A share is a percentage of a business. So if we were in a room and we had 100 shares, everyone had one share, we had 1% of that company. So I look at it as a business owner. And when I'm looking at a business, I'm trying to see how much the business is worth and trying to find out what the market is pricing it at vis-a-vis a stock. So when the stock price is way below the underlying worth of the business, that's the time I would be buying. And when the stock goes way above the underlying worth of the business, I look to sell and move on. That's basically it.
Now, I agree. But what's been happening the last couple of years, maybe even longer, is people are essentially playing the stock market like they're playing slots. And essentially they're riding momentum and that sort of stuff. How do you approach that sort of angle on investing? I mean, what do you tell people who are saying, yeah, but I feel like I'm missing all these gains and things? What's the way that you address that kind of sentiment?
You know, in a capitalistic economy, in a society, there will always be people richer than you, making money quicker than you. And if you want to play that game, then you'll be on a treadmill for the rest of your life and you'll never end up with any money. Yeah. The way wealth is made is not by chasing it and not by playing momentum. And if you just pick up the Forbes 400 list and you see how most of these investors made money, they didn't do it by penny stocks, they didn't do it by options, they didn't do it by futures. They did it by buying great companies when they sold at discounted prices, and then they just sat on their ass and waited to go up. It doesn't get more complicated than that.
It was good enough for Warren Buffett, that's for sure. Now, we've been seeing a lot of action on the IPO front this year, and I know you have some strong thoughts about that. So as a closing comment, can you tell us, just in a nutshell, how do you feel about IPOs?
Well, they should be avoided by sensible people. And I've been on Wall Street. I started in 1983 as a floor trader, and I was a money manager and a hedge fund manager. And I learned one thing. When Wall Street's selling, you definitely don't want to be a buyer. They're not there to help you. They're not the American Red Cross. They're not there to support you. If you're on the other side of a trade and Wall Street is there, you are on the losing side. IPOs are basically pieces of companies that insiders are trying to liquefy and sell into the marketplace. So for example, Lyft is an example. I just looked at Lyft a couple of weeks ago. Lyft, the insiders got options around $13 a share. IPO came out, these guys made 500%. Investors who bought at $72, IPO went up to 70 and then plunged down to 40. So they basically lost almost half their money. So tell me how that's ever a good investment. Right. If you want to buy an IPO, wait and wait and wait until it comes down. And if it doesn't come down to a proper valuation, walk away. There's many fish in the sea, and there's New York, you just miss one subway, there's one right behind it. So there's no reason to chase them.
So there you have it, folks. Be careful what you do with your money. You want to invest in companies that make it, not companies that waste it. This is Ted Bauman with Charles Mizrahi at the Total Wealth Symposium. We look to see you again soon.